We saw the NSE All-Share Index down slightly on Friday, but volumes were improved. The market obviously not very concerned about President Goodluck Jonathan's appointment for Vice President Mr. Namadi Sambo.
Yeah, the market declined slightly on Friday. Market not really looking at the information on the political circle, and I don't think that's a factor that the market considered in trading on Friday. Activity improved, as you said, and then an interesting thing about the improved activity on Friday was that you can see the breadth in market activity. There's a bit of shift from the banking sector, which ordinarily in the past used to account for like 75% of activity in the market, coming down to about 38%, and other sectors like the brewery, building materials, food and beverage sectors, getting market share in the activity in the market. So you can see attention focusing on other sectors of the market as opposed to the largely considered activity on the banking sector in the past.
And one of those sectors or the counters that performed very well last week was Cadbury's, up some 27% on the week and 4.79% on Friday. What is driving interest in this particular stock? Is it just a case of it being a defensive stock in these turbulent times?
Yeah, basically, Cadbury's case is it's very straightforward. The significant interest you've seen in Cadbury is investors' reaction to return to profitability. In its Q1 numbers, Cadbury reported an operating profit and also a net profit. It's only done that. That's the first time in over 2 years that Cadbury has churned out a profit. So investors' reaction is just extremely positive at this point. And I think the company is on a cost-cutting spree. It's basically sacked a lot of its staff, outsourced a lot of functions, and just trying to make itself a lot more efficient. And also, Cadbury Shrep oversees significant interest in the Nigerian operation and also giving it a boost. So overall, I think investors are interested in Cadbury just because of the turnaround story, really.
And what was the fundamental reason for their turnaround? Was it just cost-cutting measures, or are they improving efficiencies or expansion? If you can just give us a sense of that.
Okay, exactly. Apart from the cost-cutting, really, another interesting thing is the capital structure. In the past, it has negative shareholders fund and basically running on debt, which are very expensive because its debt are domestic debt in Nigeria, which are running in the range of 18 to 22%, depending on when you look at it. So I think investors looking at the fact that the company has recapitalized, taking a lot more equity now and repaid a lot of its debt, so you can see that pressure on the interest expense front, coming down significantly, and has a lot of long-term financing to execute this project. It has some expansion plans, on the way. We recently commissioned its gum plants, and you see all these improving its sales figure, and we expect it to grow market share, in the next couple of years.
I just want to chat a bit about some of the issues going on in the banking sector. As we've said, that there are sort of bearish sentiments going on there right now. But on the one hand, we had Sterling Bank out with quite impressive Q1 results that seem to sort of mitigate the full year losses that we saw for last year. Q1 pre-tax profit up 137%, but the stock did lose some 2% on Friday. Just tell us a bit about what's going on there.
Basically, Sterling Bank case, it's very straightforward as well. A loss of 9 billion at the full year, 15 months ended December 2009, and that was disappointing to the market. But fortunately for the bank, again, it released Q1, close to that period, same period again, and Q1 numbers shows improvements, in its business. But I think what's worrying for investors and why you saw the 2% share price decline on Friday was that the shareholders' fund has been significantly deteriorated, and basically what has happened is it has a shareholders' fund of 21 billion naira now, which is below the regulatory minimum of 25 billion. And that's worrying for investors, because what will happen is that Sterling has to recapitalize to be able to operate in Nigeria, because it has to have 25 billion naira capital base. And so the times of the recapitalization, what's going to happen, no one knows. And I think investors are just a bit apprehensive over that fact that its shareholders fund is below the regulatory minimum, despite the fact that it has improving performance in the Q1 numbers.
Mm-hmm. And on that capital raising front, we saw Fidelity Bank saying it's going to use the proceeds of a planned 200 billion naira bond sale this year to boost funding for factories and the oil industry in Nigeria. Obviously, this is quite a good thing in terms of the petroleum industry bill coming out to help support local oil producers and oil marketers. But what are the potential risks and how could that impact Fidelity Bank?
Well, I think that makes sense for me, really. I think what Fidelity Bank is trying to do makes so much economic sense and financial sense. And the reason why I said that is this, you're taking long-term finances in terms of corporate bonds from the market at a time when yields are so low. So they'll take advantage of the pricing in the market right now. And obviously, since they can see the outlets, for lending this money out into profitable areas, which is the upstream oil and gas sector, which is obviously going to benefit from the local content bill that has just been passed. I think that tenor matching makes a lot of sense at this point in time, and you can make a lot of spread looking at the pricing in the bond market right now. But one thing I need to be, just a caveat I need to put is that as long as those outlets are there for that money, then it makes sense. But if they are not, as we can see right now, that lending is still a bit curtailed, if we can't see that lending outlets right there, and if those anticipated lending outlets are not there, then taking money at the corporate bond market right now, to me, would just be a misnomer. Looking at the fact that a lot of this money are in liquid assets that are yielding close to nothing, really. The money market still at the rate of 5%, treasury bills less than 5%, and even the bonds still trading at historic lows. Also, it shows me that you need to lend to just make money in the banking sector right now. So if Fidelity has that plan to take that proceeds to lend to the oil sector, to me, I think it makes perfect sense at this point.